What is the real impact here? Judging by the market's sort of, extreme reaction, either up or down to this, obviously it is moving based on everything going on in China. To AGF Chief U.S. Political Strategist Greg Valliere, Janney Chief Investment Strategist Mark Luschini. Mark, begin with you on what the markets are telling us today on a down week. I always wonder whether they're using this as an excuse to take some profits, not go into a weekend, where anything can and probably will happen. What do you think?
Well, I think it's a couple of those things, Neil. I mean, the fact of the matter is the market isn't inexpensive. We're trading at about 19 times forward earnings, and it would have been something if it wasn't this that might have put a little pressure on stock prices. But clearly this is hitting the tape as investors are really struggling day over day as to what the potential impact is from this. I mean, it's very fluid. We don't know what the magnitude of the economic impact is going to be on China. And so far, the reverberations here in the United States have been pretty modest. I mean, we had some excellent reports already coming out this week about manufacturing activity in the U.S., except for today, where we got a market PMI reading that was relatively soft compared to last month. And so we don't know fully the extent of what the impact is going to mean to corporate earnings and economic activity. So at this point, it's really hard to take a hard and fast judgment on what the outcome is going to be, and that's what's pressuring the tape.
Stepping way back from it, Greg, and you look at consumer confidence surveys and just Americans' view of where they stand, where their kids stand, we're looking at multi-year highs. One survey back to levels we haven't seen since around 2004 through 2005. What do you make of that?
Well, I think there's a disconnect here, and I've been on the road all week, Neil, seeing investors in the U.S. and Canada, and they almost unanimously say the markets have underestimated the virus. They've been too sanguine about the virus. And maybe one of the reasons why the markets have held up fairly well is a belief that there may have to be more stimulus, monetary and fiscal, not just in China. Maybe even the Federal Reserve by mid-year may have to cut rates again if this virus doesn't come under control.
I'm beginning to wonder, Mark, whether we can trust, and I said this before, a lot of the information we're getting out of China, I've always suspected that going back to the early days with economic numbers and GDP reports and all that. They're not reliable. They've reneged on trade deals in the past. I'm not meaning to add to their woes, but to say we largely rely on data or stats coming out of China courtesy the Chinese government. And I'm wondering if we hang our hat on that to our own risk. What do you think?
Oh, I would agree. And I would say that because of this concern, we may not even be close to seeing this peak. It could be several more weeks before this really peaks. And I think during that period, the volatility in stock markets will only increase.
Mark, taking a separate look at what's been happening in some of the markets, technology, for however beaten up it's gotten the last couple of days, has still advanced appreciably. I believe about 7 or 8% on the year. If you look at the NASDAQ, even more. If you look at the NASDAQ 100, even more. If you look at what's been going on with Apple, then lo and behold, we discover that Warren Buffett's Berkshire Hathaway has a big bet on Apple. I think it represents about 14% of its overall portfolio or weighting here. That's a lot. What do you make of that?
Well, it really is. I mean, it has something to do with the performance of Apple, though.
Absolutely.
Remember, since he bought it, it was acknowledged that he bought it in early 2016. It's up 185%. In fact, Apple's up 85% in just the last year alone. That compares to a 20% gain in the S&P 500. And relative to his other top 10 holdings in Berkshire Hathaway, the next best performers are JP Morgan and Coca-Cola, up about 30% on a trailing 1 year. So a lot of that sizing has to do with the appreciation in Apple specifically, but needless to say, it's also a great company with a moat business that is something that he would be attracted to. As for typical investors, having any position represent 14% of the portfolio might be an overweight that deserves some trimming, but it doesn't necessarily have to be an indictment of the prospects of Apple going forward.
Greg, the one thing I worry about, I know you're not, steeped in stocks and all that, but I always think that a lot of companies might use what's going on in China as a convenient excuse if they have a bad quarter or, a lousy period. And it will feed on itself. In other words, it could be a pull over the markets or something to hang on to and say, all right, if not for that, we'd be doing a lot better. Of course, there's no way, to prove that. But what do you think?
Well, it's a slippery slope, but as a Washington analyst, I just say this, Neil. All this talk about break up the tech industry, break up the banks, all this stuff we're hearing from the left, from the Democrats, is crazy. It's never going to happen. It would have to assume a premise that the Senate would go along, and that just simply is not going to occur.
No, it takes a crisis to get a lot of that stuff done, right? I mean,
Yep.
and they would have to
Yep.
be elected in a crisis wave and a full sweep of the House and Senate, and that's tough to pull off. Things
Yep,
could change.
absolutely.
Guys, thank you both very, very much.